Right, good afternoon. So it took me a while, as always, to set up the whole thing here. Today we're going to continue what we saw on yesterday, and yesterday we introduced the basic accounting equation. Remember, so we said assets are equal to liabilities plus equity. Therefore, the equity must be the difference, right, between the assets and the liability. And we saw the other day, yesterday, we saw the financial statements of Campari, and we observed how they reported their equity. I remember it was like 2 billion euro, and then we compared this with the market value, which was 14 billion. We said the purpose of financial statements is not to report the market value of a company. The purpose is to determine the value of the assets and liabilities, and therefore the equity for the company that's using those assets, right? Not for the market. That's why the book value that we have in financial statements is not the same as the market value, because there are plenty of resources that we cannot report in financial statements. And we made several examples already. Remember, we said, knowledge, the skills your employees, your reputation, even your brand is something you don't report unless you meet specific criteria for those items. Remember, future benefits, control, and a reliable name. So in a way, the measurements we have in financial reporting are understated. So there is an understatement of the equity of the company, which is made on purpose. Okay, so we'll learn why this is done on purpose, and we'll learn what is the reason why there is such an understatement. Because you might wonder, why don't they report the market value? Right? They know there's a market, so why don't they report the market value? Well, first of all, not all companies have a market value you can determine so easily, because not all companies are listed. So there are techniques we can use to determine the value of a company. A company which is not listed, okay, on any market. Though, of course, those techniques require a lot of judgment, and they're not reliable enough to be incorporated in financial statements. So you'll learn, right, to continue to study business. You'll learn, probably not during this program, but maybe when you attend some master programs, you learn how to learn about business valuation, okay, which is a problem of determining the value of the business, which is not listed on the market, which is not the book value, but the market value. How can you do that? Well, you need to essentially determine or forecast, okay, the future earnings, and then you need to calculate the present value of those earnings. So it's certainly a complex and highly subjective calculation. So the equity we see in the financial statements is also known as the net assets. We use very often this term in accounting, net of, so without, okay, so net assets without liabilities. Okay, so the net assets minus liabilities, the net worth of the business can be, this is shown in the balance sheet. And today we're going to better understand how assets, liabilities, and equity change. Because we say that the equation says that assets must be equal to liability plus equity. Okay, it doesn't say that they don't change. They do change. Actually, they change every day in the life of the business. However, they change in a way that this equation always holds true, always. Okay, so we'll see what is the reason for this. So some important conventions about measurement. Okay. Accounting has plenty of those assumptions and conventions we need to know if you want to understand the financial reports. The first is related to what we said the other day when we were talking about the corporations. Remember, we talked about limited liability, and we said in a corporation there is a legal separation between the owners and the business. So the corporation is a separate legal entity, a separate legal person, okay, with rights and obligations, and the obligations of the corporations are not the obligations of the owners of the corporation. Okay, that's a big invention that allowed people to undertake very risky enterprises without risking the entirety of their wealth, just a portion of their money, of their wealth. So in the corporations, there is a legal separation between the shareholders and the company, the corporation itself. This is of course not always true in other forms of business. For instance, in a sole proprietorship, remember, or a partnership, you don't necessarily have separation legally. However, we do prepare the financial statements even of individual businesses or partnerships. Right? We prepare the financial statements of all those businesses, and we pretend there is separation. Okay, so we pretend that there is a distinction between the wealth of the business and the wealth of the owners, even if legally that's not true. If you think about it, if you're the only owner of a business and you have unlimited liability, which is, by the way, it is the norm. We all have in our life unlimited liability. If you kill someone with your car, could happen. Okay, you have unlimited liability. It means you have to besides, of course, any other consequences, but you need to repay the damages to the family, okay, of the person that was unfortunately killed by your car. You have to pay damages which are not related to how much you have. Okay, so you must pay millions, okay, of euros, even if you don't have them, because you have unlimited liability. So putting a cap to your liabilities is really an exception to the rule. Normally, we don't enjoy this unlimited liability. That's why when you insure your car, typically the maximum amount the insurance company is going to make is like 50 millions. And it may seem ridiculous. Who's going to pay 50 millions for a car crash? But there are cases, unfortunately, where the damages are very, very high. Okay, so it is important that the insurance company has the right level of coverage for the risk. So now you know why economics is called the dismal science. Right? We had to deal with this kind of stuff. So the entity concept says that the companies or the business is separated from the owners, and therefore we can measure the equity of the business, because otherwise, if the owner has unlimited liability, there's no distinction between the assets of the firm and the assets of the owner. So there's no point in measuring the equity of the firm. Instead, we pretend, okay, there is a distinction, although it's not legal, but we pretend there is a distinction. We keep preparing the financial statements for the specific business, even if it is not a corporation. Now, we are going to deal with corporations in our course, so we'll assume that we deal with corporations in general. Okay, so we don't have to worry about this, but keep in mind that accounting is also, we prepare also financial statements in real life of small businesses, individual businesses, partnerships, and so on. And we follow the same rules. We apply the same standards and the same rules. Another convention which we have already more or less introduced is that anything must be measured in money. Okay, so anything you cannot measure is not reported. That's why you don't report your reputation. That's why you don't report the how skilled your employees are and so on, because it is close to impossible measuring those resources. This is also why, besides financial reporting, there is plenty of non-financial reporting. As I mentioned, there's a trend in reporting information about the the environment, the engagement with the social community, and so on. If you read the financial statements, there are a lot of pages on those topics because this is something you cannot measure precisely with money, and yet the investors and users think it's important. So users think it's important, and so it's important for companies to show how much attention they pay to these topics. And say a more technical issue, which is going to have important consequences for us, is the historical cost convention. Now we're going to introduce some terms that we have already seen, I believe. The term of historical cost. Okay, it's typical of accounting. Historical means that it happened. Okay, it's not just an assumption about the future. So when you purchase an item, you pay a cost, you pay a price. That's historical cost. Okay, so if you buy a smartphone, then that's the amount you pay, that's the historical cost. So the idea is that anytime an asset is recognized in your statements for the first time, so when you purchase an asset, the value of this asset is equal to its historical cost. So if you pay 200 for your smartphone, this smartphone is worth 200. It may seem silly. Why are we talking about this? Because you might argue, well, I paid 200, but it was really a bargain, so the value is much greater than that. Maybe it's worth 300. Okay. Well, you cannot do that. You cannot report 300 just because you think the value is greater. You stick to the historical cost. Okay. This is going to have some consequences, as we'll see. But also, it is also the convention that makes sure that the basic economic equation holds true, essentially, because we say, for instance, the other day we said, can you invest more than your liabilities and equity? And we said, no, why not? Because we apply the historical cost convention. So even if the value of the assets is somehow greater than what we have paid for them, you cannot report this. So eventually, the value of the assets will be always equal to the value of the liabilities plus the equity. And we need to separate in accounting the moment of recognition. This is when the item is recognized for the first time. It appears for the first time in your financial statements, from the moment of measurement, which happens after recognition. I mean, we purchased a smartphone today, okay, October the 8th, and it appears in our financial statements as equipment, right? That would be the name. It appears for its historical cost, 200. At the end of the year, December the 31st, we need to prepare the financial statements. And that's when we worry about the value of this smartphone. Is it still 200? Is it less? Is it more? Okay, so this is what we probably try to solve at the end of the year when we prepare the financial statements. That's the measurement phase. And the measurement could be done at cost. So the value would be 200, okay, minus a portion of what we call depreciation, because now it's not brand new anymore, right? So when a used phone is worth less than a new phone, we know that. Why is that? Because a used phone has lost some of its usefulness, okay, some of its life has gone. Okay, so you need to lower its value. This is called, as we see, depreciation. Or, in some cases, you could apply market value to your phone. But I mean, it doesn't happen. Just bear with me, just an example. So you should see what the value in the market is now after 3 months. Probably would be certainly less than the original value. Okay, but there are some cases where the value could increase, not for smartphones clearly, but for other kind of investments. And then, talking about measurement, there are some important assumptions. The most important assumption is called prudence or conservatism. Conservative means that we need to be conservative in estimations. Okay, so we know we are introducing errors okay, in these estimations. And these errors are in one direction only, in lowering the equity. Okay, so we don't overstate the assets, and we don't want to understate the liabilities. Okay, so this is a very important concept. And as we'll see later, every asset and every liability is subject to estimation. And for each of these items, you have a range of possible values, from a minimum to a maximum. And by that, I mean, there are several ways of measuring assets and liabilities, and they're all acceptable, all rational. For instance, you could use historical cost or market value, right? But even if you choose one of those two methods, then you have some options available. For instance, if I apply historical cost, should I also lower the value because there is a decrease in the usefulness of this item, and by how much? There is some judgment here. Okay, you need to apply your judgment and determine the value. If you decide it's going to be the market value, once again, the market value could come from different sources, and it could fluctuate. It could you could talk about buildings, for instance. You need to ask an expert, okay, what the value of the building is, and maybe if you ask 3 different experts, you have 3 different estimations for the value of the building, right? So it's still, we have a range of possible acceptable values for all the assets. I think this is quite simple to understand. That for each asset, you have a range of possible value. Sometimes this range is not very large. I mean, sometimes it's pretty easy to measure an asset. Other times it's quite complex. There are some, especially some financial assets that are difficult to measure, for which the range is quite large. Even for liabilities, we have a range. Have you thought about that? Even liabilities must be estimated sometimes. Why is that? Well, for instance, you might say, well, if I owe 100 euros to someone, the value is 100, right? This would be the simple answer to this measurement problem. But then, what about the interest? Is it included in this 100 or not? It's a problem of measurement. I need to be paid 100 plus interest. So do I also include the interest in this number or not? And that would be one simple example of measurement of a liability. There are more complex issues with liabilities. For instance, someone claims that we owe them 100. Is it true? Well, maybe not. So some liabilities are just potential, maybe not even sure. Or we run the risk of paying 100 to someone in the future. Maybe because there's a controversy. Maybe the product we sold caused some damages to the client, and now the client is asking for money. And we don't know whether we're going to pay or not, because maybe we go to court and there is a legal procedure, and the judge will decide whether we're going to pay or not. And should we report the liability or not? And by how much? So there are a lot of issues we need to solve, even when talking about measuring liabilities, not just the assets. Even liabilities create problems. Well, in both cases, assets and liabilities, we need to keep in mind that we need to be conservative. Okay, that means if you're not sure about an asset, we don't report it. Okay, if we think we're going to get some money next week, we don't write anything, okay, in our accounts until we see the money, actually, because we don't have the right to collect anything. If we think we're going to pay money in the future, then we're going to write a liability. Okay, we're going to report a liability in our financial statements, because we tend to report the bad news faster than the good news. Okay, so bad news appear much faster, much earlier in the financial statements rather than the good news. And I will explain why we do this, because it might seem strange. It is a distortion It is distortion. It is a bias, as someone says, which means distortion. It's a bias in the measurements, and there is a reason why it's been introduced in financial statements. You can have accounting system with a very strong prudence applied to them, or others that have let's say, lower degree of prudence. It's not the same in all financial standards. And you learn if you continue to study accounting that typically in many countries in Europe, prudence is very strong, while according to the international accounting standards, and they stem from typically US and UK standards, prudence is less strong. Okay, so it's somehow less important. But there is, of course, prudence, but it's not as important as it is in Italy or in France or in Germany. Another important convention is the going concern convention. Concern is the business. Okay, so we assume that the business is going on. We assume that the business is going to continue to exist in the future. This is important because if you remove this assumption, and then you have the financial statements of a company that's shutting down. Okay, so a company that does closing down its operations, then suddenly many of the measurement methods we employ are not applicable anymore. For instance, what's the point of measuring something at cost, at historical cost, if there's no future for the company that's supposed to use this resource, right? So we measure everything at market value because in case of liquidation means when you sell the assets with the money you get, you pay the liabilities, and then you share what remains. What remains is shared among the shareholders. Well, in case of liquidation, there's no future, so there's no point of using historical cost. There's not even a point of separating the assets between current and non-current. It's always current. Okay, so it's a different form of reporting. There are liquidation financial statements. That's the end of the line, okay, for the company. The end of the line when the company shuts down its operations, we prepare the liquidation financial statement, which has different principles and different measurement methods than the financial statements we prepared on a going concern assumption. And for instance, we mentioned that auditing is one of the branches of accounting. One of the most important decisions sometimes auditors must make is to determine whether there is still a going concern, if there is still a future for a company, and if the standards applied are consistent with this or not. Because otherwise, you need to change the measurement method for the assets and liabilities of the company. So we won't deal with bankruptcies and liquidation. So we assume that these companies we analyzed are going to continue to exist. And another assumption is the stable monetary unit convention, meaning that there's no inflation. Okay? Now, maybe not all of you know why there is inflation, but I think that all of you should know what inflation is, right? It's a decrease in the prices. Okay? And we're talking about inflation right now. It seems like it's coming back. For instance, there is certainly inflation in energy prices. Okay? The price of electricity, natural gas, fuel, it's all increasing. Okay? For macroeconomic reasons, by the way. Macroeconomics is one of the topics we're going to study next year. So there are geopolitical reasons, okay, for this increase in energy prices. This is inflation essentially, okay, and inflation makes all the prices increase, and therefore think about what happens to your financial statements. Especially when you measure the assets at historical cost. You have a building that you bought 10 years ago. okay, and you keep reporting this building at cost. What is the value today? Well, maybe because of inflation, the value report in the financial statements is not meaningful anymore, because in the meantime, all prices have increased. Well, we tend to ignore this, okay, so we pretend inflation does not exist, okay, which is weird, because even if inflation is low, inflation currently in the euro area is really, really low. It's historically low. Okay, so let's say 1%, something like that, even more, less than that. Now it's going to increase. Okay, they are talking about 3%, so it's a large increase. But even when inflation was 20%, and it was like 40 years ago. Okay, 40 years ago, inflation was in the, well, not in the euro area because we didn't have the euro, but for instance, in Italy it was 20%. Even then, there were no adjustments to inflation, even then, because we pretend it does not exist, and then from time to time there are some restatements, but they're not incorporated in the accounting system. However, there are places where instead inflation is endemic, or it was endemic, and where they experienced hyperinflation. Hyperinflation means something like 1,000%. Okay, so very, very high inflation. So in those conditions, it's clear that the extra days prices are not really meaningful anymore. They change every day. So very often you have countries that maybe experienced this in the past. Now they incorporate automatic adjustments for inflation in their accounting systems. But we don't do that. So, for instance, some countries in South America, for instance, they experienced hyperinflation in the 80s, and today they have some adjustments. Even if today is not as high as it was back then, but they could introduce some adjustments for inflation in their financial statements. We don't do that, and neither under international standards nor under national standards in Europe, we don't have that. Okay, so we pretend it does not exist. And this is also, let's say, one of the shortcomings of accounting. Now we could consider inflation because it's not impossible. It's very complex. And so if you continue to study accounting, you learn how to do it, but certainly not in this course, not even next year. Okay, it's something you study in more advanced programs. So, remember what we said about assets, liabilities. Okay, so let's just recap what we have seen so far. Examples of assets. Remember, economic resource with future economic benefits. Cash is an asset, merchandise, inventory. So, starting to introduce some terms. The inventory, remember what inventories are. Okay, so the items the company uses for production or the company sells. Okay, so merchandise, and it's important to keep them separated. Okay, merchandise is something we buy and sell. Okay, so merchandisers buy and sell goods. Think about the grocery store. Okay, what you see on the shelves of the store is merchandise. Furniture, land, those are all assets, and actually those are, there are many other assets such as intangible assets and financial assets which are not included here. Liabilities. A quick way to recognize the liabilities, very often they have the word payable. Okay, so this is the trick. Anytime you see something with the word payable, it must be a liability. Okay. Please keep this in mind because I don't know why. And then after a few weeks, some students tend to forget this, and they tend to mix liabilities with expenses. Okay, if you do that, that's a fatal error. Okay, in your test, so would be the end of your exam. If you mix expense with liability, and we'll introduce expenses today, but be careful not to confuse the two different terms. So accounts payable. So those are also known as trade payables. Accounts payable to suppliers. Okay, so suppliers of goods and services, because companies buy on credit. Okay, so companies don't need really engage a lot in immediate cash transactions. Okay, they buy on credit, and in business-to-business transactions, they sell on credit. Okay, so if the company buys materials, it's going to report a liability, which is called an account payable. A note payable is something very similar. We'll learn what the difference is. It's somehow more formal than an account, and we'll learn how to treat them. And then there are a series of other payables, such as salaries payable. Okay, so for instance, you owe the employees some money, that's a salary payable. Income tax payable, interest payable. Okay, all those payables are liabilities. Okay, so we learn how to recognize them. The equity. Now we're going to connect the financial position that we have seen so far with the financial performances. Now we're going to explain what the financial performance is. So the equity, also known as the shareholders' equity, stockholders' equity. Okay? It is different if you say stockholders, shareholders, because sometimes we use the term shares, other times the term stock. I never understood why. Okay, but this distinction, maybe it's something related to different between British, English, American English. But anyway, in the business, especially when you look at the financial statements of companies from non-English speaking countries, they don't care that much, okay, about the distinction. So they can use the one or the other without any problem. So the equity or shareholders' equity in a corporation increases and decreases for a variety of reasons. But remember, the equity is just a difference. So the equity cannot increase or decrease by itself without the change in the assets or in the liabilities. Remember, because assets minus liabilities are equal to the equity. So if the equity changes, something must change, okay, the other side of the equation. Either the assets or the liabilities or both, okay, in some cases. And today we're going to explain what revenues and expenses are and what is the difference between revenues and expenses and contributions and dividends. Okay, but I'm going to start from contributions actually and dividends. Now the equity is the net worth of the firm. Remember, we said this is the amount of the part of financing that you don't have to pay back to the creditors, right? Because the investors put their money in the company, and when you invest in the equity of the firm, you don't have a legal right to get your money back. Okay, remember, this is a very important difference between liabilities and equity. If you lend the money to a corporation, you have a legal right, you can enforce. Okay? If they don't pay, you can sue them, you can go to court. If they don't pay, you can enforce your right to get paid. So that's when you lend money, and then you're a creditor of the corporation. When you invest in a corporation as one of the equity investors, you become one of the owners, one of the shareholders. Okay? And as an owner, you don't have the right to get your money back. You have other rights. You have, of course, the right to a portion of the profits, but you are one of the owners. Okay? Even if you own a very, very tiny fraction, okay, of the corporation. So we can buy shares of very large corporations like Microsoft or Amazon, and we can buy shares. We own a very, very tiny fraction of the equity of those corporations, but yet we are owners. So we don't have the right to get the money back because we became the owners of a tiny fraction of the corporation. We have the right to get the tiny fraction of the profits, okay, of those corporations. You don't have the right to get your money back. Okay, this is the most important distinction between equity and liabilities. So, by the way, in case of insolvency of the firm, would you prefer to be a creditor or an investor? Yes? Creditor. Investor. A creditor. A creditor, okay, would be better because it's less risky. Because you have the right to get your money back. Now, if they don't have money, you're not going to get your money back, or you're going to get just a portion. Sometimes only 40%, 30%. If you're an investor and the company is insolvent, I can guarantee you're not going to get anything. Zero. Nada. Why is that? Because it is difficult already to pay the creditors, and they are going to be paid before the investors. So first, any money available is going to be used to pay the creditors. And if there is something left, then it's going to be used for the investor. But in case of insolvency, by definition, it means that there's not enough money for the creditors. Okay, otherwise the company will not be insolvent. You're insolvent when you don't pay your debt. Okay, that's the meaning of insolvency. So it's definitely a riskier position to take. Investing in a stock, in the equity, okay, in equity instrument is riskier than investing in debt instruments, okay, in the liabilities of the firm. You can choose because large companies issue financial instruments, both equity instruments, shares, and debt instruments, bonds. You can invest in both, but there is a different risk profile, okay, between the two different instruments. So if you're one of the owners, you contribute to the company with your money. Okay, so those are called contributions. And of course, when the company receives your money, the equity of the company increases, and so do the assets, right? Because remember the equation, okay, you cannot just increase the equity and that's it. If the equity increases, then you need to study what happens to the other side of the equation, assets and liabilities. So the assets increase because the company collects money, and money is an asset, cash, and the equity increases. In case of dividends, dividends is the name we use for the share of profits which are distributed to the owners. Okay, so periodically, typically once a year, okay, companies distribute a dividend. I mean, if they have a profit, because not all companies make profits, and not all companies distribute dividends. Okay, it's the company's decision whether to distribute dividends. Of course, this decision is made by the shareholders. Okay, so you might say, well, of course they're going to pay dividends if the shareholders vote, but they vote. And you, as one of the small shareholders, don't have any leverage, okay, here. It's the majority shareholder decides. If the majority shareholder says, no, we need the money, then you're not going to get any dividend. Okay, so this is how it works in corporation. So when and if corporations pay dividends, of course they typically do because they want to keep their investors happy. Okay, because if you don't get a dividend, you sell the investment and you invest in something else, and this makes the price of the share drop. So dividends reduce the equity. So you have a decrease in equity when you pay a dividend, and you decrease the assets. So it's the opposite, okay, of contributions. So contributions are positive for the financial position of the firm, and dividends are negative for the financial position of the firm. Typically, dividends are distributed in the spring because the companies close the accounts on December the 31st, and then around April or May, there is the assembly of the shareholders. The shareholders meet. And I mentioned, for instance, that here in Trieste, you have the assembly of the shareholders of Generali, the insurance group. Okay, they meet here in Trieste, and they vote. And they vote about the financial statements and the proposal of dividends, because the board of directors proposes a dividend, and the shareholders vote. So that's when they pay a dividend, typically. Although there are companies that pay dividends twice a year, for instance. Okay, so this is what could happen. But most companies are going to pay dividends the first, say, 6 months of the year. Dividends calculated on the profits they made the previous year. Okay, so in 2021, you get a dividend on the 2020 profits. Okay, so this is this is how it works. Anyway, both contributions and dividends make the equity change. However, assets and liabilities change for other reasons too, not just because we get money from the owners or because we pay money to the owners. And those other reasons is what they really matter to us, because those other reasons are those necessary for us to understand financial performance. Because, you know, contributions and dividends are not part of the financial performance of the firm. I mean, we want a measure of value. Okay, we want a measure of performance. We want a measure of value creation from the firm. We want to know whether the firm creates value or not. And if you think about it, dividends and contributions really have nothing to do with that. I mean, if the company receives money from the shareholders, the financial position improves. Is that value created by the company? Is that performance of the business? Not really, right? It's not like we are very good at selling, so we created value. And on the other hand, when the company distributes a dividend, of course, the financial position changes and it's worse off, okay, clearly. However, can we say, okay, this is a really bad performance because they reduce the assets, so they reduce the equity, so they are not very good at doing their job. You cannot state that, I mean, because it's just a payment of dividend. In general, any transaction between the firm and the owners, between the company and the shareholders, okay, any transactions between the company and the shareholders has nothing to do with performances. Why? By definition. Okay, this is our definition. This is our definition of performance. So you are going to repeat this like 1,000 times, okay, in the next weeks. And yet, I still sometimes hear students tell me that dividends are expenses. No, dividends cannot be part of your performances. By definition, because we don't want dividends as part of the performance, because we want to assess how good the company is at creating value. And you don't create value to collect money from your investors. Okay, so this is the point. So this will lead us to the concept of revenues and expenses, but before explaining in detail what they are, let me explain the concept of income in general, and then we'll explain what revenues and expenses are. Mind you, this is the core of the accounting course. Okay, so revenues, expenses, net income, so it is essentially the foundation of what we're going to do in the following weeks. So we want to measure performance, okay? And we call this measure income. Okay? Now, sometimes we say net income because it means income net of all the expenses. For the moment, just focus on income. Income is the measure performance, the value created by the firm, and unlike the equity, which is, you know, a picture, okay, you take as of a specific date, the reporting date, the performance is measured over a period of time. Could be 1 year, typically. Okay, so we have the performance to be the net income for the year, could be 1 semester, 1 quarter, 1 month. At least once a year. Okay, so at least once a year, companies measure their income. So the income is defined as the increased profit or decreased loss in the equity over a period of time. This is the definition. In order to have an increase or decrease, you need 2 different observations. One initial observation of the equity and one final observation of the equity. You need 2 values of the equity, one final, one initial and the other final. However, the change in equity is calculated without considering transactions between the firm and the owners of the firm. This definition here is from the International Accounting Standards. Okay, so that's why you see the German is a little bit weird. Equity participants. Okay, it's legal German for investors. Okay, so investors in the equity of the company. So we need to measure the change in the equity of the firm without considering dividends and contributions. Okay, so why is that? Because dividends and contributions do affect the equity, but because there are changes in equity which are due to contributions and dividends. However, those changes in equity due to contributions and distributions have nothing to do with performances. So we don't want them. We don't want them in our concept of income. So how can we describe this in a formula? Well, the formula would look like this. Your income would be equal to the equity at time one, which is equity at the end of the year, okay, minus the equity at the beginning of the year. So that would be the change in equity, right? So equity at the end minus equity at the beginning. This is a change, positive or negative. Okay, remember when we say change, okay, changes can be positive, increases, or negative, decreases. Keep this in mind because we're going to use this often during this course. So that's the change in equity. And then we need to adjust this change by removing those transactions that have nothing to do with performance. We identify them as contributions and distributions, right? So we need to subtract the contributions. Okay, so why is there a minus sign here? Well, here, sorry. Well, because contributions are positive, right? And they made your equity increase. However, this increase is not a performance, so we don't want them. So we remove them. Okay, so minus. Now, of course, we are talking about contributions that occurred in the same period for which we're measuring the performance. Okay, so we want to measure the 2021 income. You calculate equity as of December the 31st, 2021, minus the equity as of January the 1st, 2021, minus any contributions that happened, that occurred in 2021, not the contributions that occurred in 2019 or other years, in this year, in this period, okay? Plus distributions. Why? Because if the company distributed dividends in 2021, those are not part of your performances. So we need to eliminate the effect of these movements of equity from our calculation of income. Okay, so very quick example that we'll try to we'll see why this is really not really convenient for us to calculate, because it requires gathering information about dividends and contribution, which is not immediate. Okay. So this is not how we are going to report performances. However, this is the concept of performance, which is very important because the next step we'll make after the break would be linking this definition with revenues and expenses. Okay, so this concept is important because it will allow us to understand the connection between the financial position and the financial performance. Allow me just to make an example here. If your equity at the end of the year is 120, okay, let's see, I can write here somehow. Oh, come on. Okay, let me try again. No, it doesn't work. Okay, let's try again. What's going on? Why? Oh, okay, let's take a break and I'll rectify what's going on here. And 10 minutes, and then we'll resume and we'll use revenues and expenses. Okay, so let me explain this convention that we introduced because some of you asked me to explain what T0, T1 mean, and this is time 0 and time 1. Okay, so if you have this time essentially, and this is time 0, would be January the 1st, and this is time 1 would be December the 31st. Okay, so those are dates. Okay, and this is the year, and we calculate the change between time 1 and time 0. So for instance, the equity measured at time 1 would be 120, and the equity euros. Okay, and the equity measured at time 0 would be 100. Okay, so clearly the difference between equity time 1 and equity time 0 would be, of course, 120 minus 100. Okay, so 20. And that's the change. Okay, of course, in this case, the change is positive because the ending value is greater than the beginning value. You can also have negative changes in the other way if the ending value is less than the beginning value. Now, by itself, the change in equity is not by itself a measure of performance. Okay, we need to adjust this change by including contributions and distributions. So we need to gather some additional information, which is not here. We don't see this information directly when you observe the equity. So assuming that we have contributions of 5 and we pay dividends of 15. This is something we need, information we need to find out. Okay, it's not like it's clearly evident. Just by looking at the equity, you can tell whether there were contributions and distribution between time 0 and time 1. If that's the case, assuming that we know this, then net income will be equal to 20 minus the contributions and plus dividends. Right? That would be therefore 30. Okay, this is the result. Okay, so 30 would be the value created by the business over the year because we know that the change is 20 and we know that we paid 15 and we also received 5 as the contributions. Okay, so if you calculated if you apply the formula we have seen before, you realize 30 would be your net profit. Okay, it would be your net income or profit because it is positive. Now, as you can see, it works. I mean, you can determine the performance. It's a little bit complex because you need to gather information from other sources. You need to determine the amount or find out about dividends and contributions. But most importantly, knowing that the performance is 30 is, of course, interesting, but we don't know why it is 30 and not 25 or 35. Okay, so we get no information about the reasons, about the activities that led to this specific performance. We just get the rough number, which is the result, which is, of course, correct. It's the net profit. However, it is not exactly what we would like to know. We would like to know more because we want to be able to assess this performance, to better express our opinion, okay, about this performance. So, what is the idea when you talk about performances? The idea is the following, and this is in order to clarify why we, in case you had doubts, why we don't want contributions and distributions in this picture when we talk about performances. So, if this is clear, let me know if you have doubts, okay, because it's simple, but maybe if you have doubts, let me know, and it is better to express your doubts now, okay, rather than a few weeks from today. Yes, please.
Why do you subtract contributions and add distributions?
Because contributions are positive
and the dividends are negative, right? Because contributions make the equity increase. So certainly, contributions are included in the final value of the equity. I mean, this 120 here, or where is it? Okay, I'm just looking for my tablet. Includes contributions and distributions, right? The final value includes contributions and distributions. You just observe the final equity. The final equity is affected by contributions and distributions and by the performance of the firm. So if you only want to calculate the increase in equity due to the business operations, or we'll define that in a moment, or due to the production of the firm, you don't want contributions, you don't want distributions in the picture. So we remove the effect of contributions and distributions from this calculation. And since contributions increase the equity, we need to subtract contributions, and distributions decrease the equity, so we need to add them back. Is it clear?
Yes.
Okay. So the signs are the opposite of the effects they had on the equity, because we don't want them. Okay, we would like to calculate the equity without contributions and distributions. That's why I say it's a little bit inconvenient, right? Because it's not really that simple. Now, what is the idea of performance we have, therefore? We need to realize that every business or every organization, to be more precise, is characterized by production. Okay, so we can summarize what a business does as production. Now, production in terms, in economic terms, not think about the manufacturing plant. Okay, so you don't need machinery and equipment to perform production. Production is done at all levels by all organizations. For instance, as I mentioned already, in this very moment, we are performing production. Okay, right now. So we have a production process. We have inputs of this production, and we have outputs. So there are inputs which are used in order to obtain an output or one or more outputs. Okay. So what businesses do, what organizations do in general, they use in resources in order to produce something. Okay. This output could be physical, so you can manufacture furniture, okay, or intangible. You can offer services, okay, of all kinds, financial services, rental services, educational services. Okay, so those are all intangible outputs. All organizations perform some form of production, and they all have an output. Okay, so not just businesses. You can include in the broad term organizations any kind of organizations such as non-for-profit organizations. Okay. You could include their political parties. Okay. Clubs, associations, anyone that has a goal, okay, to offer some services, maybe just to the associates of that organization or to the public in general, not necessarily with the intent to sell this output. Okay, so this output is not always offered on the market for sale. Sometimes it's simply used by the members of the organization. In this sense, even the family, okay, is such an organization that offers services to its members. Okay, so if you look at this point of view, from this point of view, we deal with production in any form of human activity, essential. Now, in order to have a production, you need to use some resources, and then you get an output. Okay, as we said, we are doing some production right now. The output is intangible, of course. It's educational service. Okay, the inputs are besides my own labor. Okay, you see the inputs are the physical inputs you see around you. Okay, those are necessary to perform this production. Okay, you don't have, you don't need a factory, okay, to talk about production. So all kind of businesses have a production. Now, of course, in manufacturing, okay, you have physical production of goods, so you have machinery, equipment that manufactures a physical output. Well, what is the idea of creating value? You want a value of your output which is greater than the value of the inputs. That's how you create value. I mean, if you use inputs to create something which is worth less than the value of the inputs, you have destroyed value. If you use your inputs to perform a production that generates an output that's worth more than the value of the inputs, then you have created value. Okay. So how do we measure the value of the output? Well, in case of businesses, okay, the value is measured by the market. So the market measures the value of what the companies produce, and hopefully the idea is that this measurement will lead to a value of the output greater than the value of the resources that were necessary to perform this production. Okay. By the inputs, we have, of course, we have labor, of course. We have the plant assets, the physical assets, the production equipment, and so on. Materials, okay, think about, it's easier to think about manufacturing. Okay? You need materials, equipment, labor, in order to create something, to produce something. Okay, so if you want to manufacture furniture, you need, of course, the employees, you need the equipment, you need the materials, the wood, the plastic, and so on. Okay, and then you create the output. And hopefully the value of what you produce is greater than the value of the inputs you have used. That's how you generate value. Okay, this is how businesses generate value. If the market recognizes the value lower to your output rather than to your inputs, you have destroyed value, and that's the loss. Okay. So this is the key here. As we'll learn, labor, equipment, materials, the inputs in general, the inputs are connected to logically to the concept of expenses. And outputs are connected to the concept of revenues that we're going to explain more in detail in a moment. Okay. What if the organization does not sell its production on the market? Okay. Well, in that case, the goal is not to create value, but it is at least not to destroy value. Okay, so the minimum goal would be no organization wants to destroy value. So even non-for-profit organizations or schools or hospitals or universities, they will tend at least to conserve value. So the idea that in that case, we don't measure the output on the basis of the market value because we don't sell the output on the market. We measure the value, the output on the basis of the value of the inputs. Okay, so if you use resources which are worth 100 to provide medical services in a hospital, what is the value of those services? 100, because that's how much they cost them. Okay, providing those services. Okay, so this is how non-for-profit organizations think. So this is the idea. That's why we focus so much on production, because we want to know whether the company is efficient in using the resources, okay, and also we want to know whether the company is effective upon it, meaning that the company achieves a result. So what's not part of production is not in this picture here, okay, and by definition, what's not part of production are transactions between the owners and the firm, okay, so not production. Contributions, dividends and contributions. Okay, so that's why we don't want them. This is not productions. Okay, so dividends and contributions, those are by definition not part of production. Okay, so we don't want them in our idea of creating value, measuring a performance. Okay, so production does not include these. So it would be complex defining what production is, because it can change from firm to firm, it can be very complex. We prefer to say that contributions and distributions are not part of production. Anything else is. Okay, so this is important. Anything else it's done in the curve, it is part of production, always. Okay, so for instance, think about the manufacturing firm. A company manufactures furniture. Okay, besides materials and equipment and labor for the physical manufacturing, converting materials into products, they also have some people working in advertising. There is someone that probably is going to worry about the financial reports, okay, of this company. And there's going to be also someone involved in security regarding the physical plant, security plant, and maybe someone doing some landscaping in front of the company. This is all part of production. Okay, so because this is not contribution and distribution. So production is very broad term. It's not like in a narrow sense, engineering, okay, we convert materials into products. Okay, that's manufacturing, which is part of production. And then production is something bigger than that. Okay, we have much, much more. Essentially, anything you can think of other than contributions and distributions. Okay, that's production. That's how we look at this problem in accounting. So this is why we do not include the transactions with the owners, because we want a measure of performance. We want to determine whether the company is capable of creating an output whose value is greater than the value of the inputs. That's our problem. And we want to know that. And therefore, you see, you cannot include the contributions and distributions. Because they have nothing to do with this goal, okay, creating value. So it's a form of assessing a measure of performance. You want to assess the company, you want to assess the management, you want to determine whether the company creates value. So this is the idea. And the method we have seen earlier, this one, okay, equity time 1 minus equity time 0, as I said, it's not really convenient because, first of all, it forces us to gather information about contributions and the distributions. And where is it? Well, I don't know. We should read the newspaper and see whether the companies pay the dividend. But moreover, it just leads us to one single number, which is the profit. Okay, that's it. That's all we know. It's the performance, which is, I mean, it's good, but we would like to know more. Okay, we would like to know something more. That's why we don't really use this method in reality to determine performances. However, this is the definition we have. Not just mine or in this course. It's from the International Accounting Standards. Okay, so it's pretty much accepted. And this definition is useful because besides connecting the equity to performances, and the next step would be remembering that the equity is just a difference. Okay, it will be that's the next step, assets and minus liabilities. But the importance here is that we can connect the balance sheet, okay, to the essentially to the performances, okay, because here we have now we introduce something which we're going to use very, very often in this course, which are T accounts. Okay, see this big T here. Okay, this is something that we're going to use very often in accounting. Now we can represent the balance sheet as a big T account. Okay, a big T, where we report in the left side we report the assets, and in the right side we report the liabilities and the equity. And that will be the balance sheet as of December the 31st of the year of time 0. Okay, so the year 1, okay, or year x0. And then you have the balance sheet as of the then the following period, the following reporting date, sorry, not the period, date, where you have the assets at time 1, the liabilities measured at time 1, and the equity measured at time 1. So what is the connection between the equity at time 0 and the equity at time 1, which is the reason why we introduce financial performance this way? Well, you see here that equity at time 1, equity at time the end of the year, or equity in the second year, is equal to the equity of the first period plus the performance. And remember, performances can be negative. Okay, so plus a positive number or minus a negative number, okay, because it's a sum, plus contributions and minus distributions. That's the equity at time 1. So there is a link, a connection, okay, between the equity at time 1 and the equity at time 0, which is given by the net income, the contributions, and the distributions. If you remove contributions and distributions for a moment, let's assume those are 0, okay, so we can just ignore them. What we get here is that the income is reported as an increase in the equity, if positive. So profits are increases in the equity, and losses are decreases in the equity, right? So a company that generates a profit has an increase in equity. The companies that suffer from losses, they have decreases in the equity. Okay, so this is what we observe just by looking at the balance sheet. More importantly, those profits and losses do accumulate over time. I mean, what is the net income for the following year? You start from equity at time 1, and then you add the new performance. Okay, so equity at time 2 will be equal to equity at time 1 plus the new income for the new period, because we calculate a performance for each period. Remember, it's a major performance that's related to a specific reporting period, not a date, a period of time. Okay, so you need at least 2 different dates to have a period. So profits tend to accumulate, and so do losses in the equity of the company. So if the company has a series of profits, the equity is going to increase and increase and increase, assuming that there are no dividends, okay, assuming that those profits are not paid to the investors. If there are losses, the equity is going to decrease and decrease and decrease. Okay, so those losses are going to accumulate in the equity of the business. So one of the issues that we face would be, okay, especially in case of losses, is there a moment when we need to stop? Is there a moment when we reach a limit and we cannot proceed further? We cannot report any more losses. Okay, we'll discuss about this and we'll see also an example. But for the moment, let's just focus on this idea that we have changes in the equity that represent the performance of the firm. Now, yesterday we saw the financial statements of Campari, remember? Let me retrieve them. So let's try to observe the change in equity, okay, in for that company whose financial statement we saw yesterday. Okay, let me just verify that I'm still sharing my screen. I don't, yes, apparently I am. Okay, so here we go. Okay, remember we observed this the case where we observed that the equity is equal to assets minus liability, but now let's focus on the amount of the equity. The total equity from one year to the other. Okay, here is the data. About 2 billion in 2020, this is time 1, and 2.3 in 2019. This is time zero. Okay, so you calculate equity at time 1 minus equity at time 0 is minus 385 millions, right? Yes, more or less, 88 millions. Okay, so that will be the change in equity. Can we assume that there is a loss? No, we cannot assume that because we don't know about dividends and contributions. That's just a change in equity. Okay, certainly the financial position is worse off in 2020 in comparison to the 2019 position because they have less equity. We don't know why. Okay, we don't know why they have less equity. Maybe they distributed dividends, and so that's why the equity decreased. But certainly, we cannot just conclude that we have a loss. Okay, so we need more information before realizing, before stating that yes, there is a loss. We don't. That's why this method is not very convenient. The change in equity because we need more information. We need to find this information somewhere. It would be easier to have we had directly information about the performance, right? So, in order to get to this result, we need to introduce the concept of revenues and expenses. And we're going to help us determining whether this is a loss or not, without searching for information that we don't have right now, because I don't know where to find information about dividends and contribution. Maybe they write something. There are 300 pages, probably. Hopefully, they write something, but or I need to find information. I would like to have this presented to me in a more useful and meaningful and convenient way. So, what are revenues and expenses? Remember what we said about technical terms in accounting. Okay, so those terms might have a meaning in the everyday language, but in accounting, we tend to be precise on how we use them. Okay, so when we mean losses, we don't mean liabilities, we don't mean expenses. Okay, so although might seem something similar, okay, close to each other, but they are different. We already know what liabilities are. We know what losses are. Right, a loss is a negative performance. Okay, so it's a negative performance is when companies destroy value instead of creating value. Profits are positive performances. The losses are negative performances. What about revenues and expenses? What are they? Well, let me introduce this and then we'll continue because I cannot complete my explanation today. So let me go back to the whiteboard and a new page here. Okay, here we go. So I have to sit down because otherwise I cannot write if I stand. I prefer to stand, but I have to sit down. So what is the idea? Let's assume that we can measure the assets at time 0, the liability at time 0, which are equal to the equity at time 0. Okay, so when we talk about the equity, we're really talking about assets and liabilities. Remember, the equity is just the difference. Okay, so you don't really measure the equity; you measure the assets and liabilities, and the equity changes only because assets and the liabilities change. Okay, so remember this effect: cause and effect. Okay, the cause is assets and liabilities. The effect is the equity. So whenever we observe a change in equity, as we did in the case of Campari, it means that the assets and liability must have changed, right? Otherwise, this equation does not hold. So we have the assets at time 0, the liabilities at time 0, and the equity at time 0. How do we get to the financial position at time 1, the equity at time 1? Well, between time 0 and time 1, between the beginning and the end, okay, of the year, the assets and liabilities change, right? Sometimes they change for reasons related to production, and sometimes they don't. So those reasons will be related to contributions and dividends. Okay, so there are only two possible reasons for changes in equity, either related to production or not related to production. So this is the idea. So some of the changes are positive. So for instance, we use delta symbol to indicate a change. Okay, you have a delta plus in assets. It means you have an increase in assets. Okay, or you might have decreases, a decrease in liabilities. Now, when your assets increase or your liabilities decrease, that's good news, right? So there's something positive for you. So this translates into an increase in your equity. Okay, so delta means change. Okay, so sorry, physics, you know this. So delta means change. So a delta in your assets, so an increase in your positive increase, positive change, an increase, or a decrease in your liabilities, that translates into an increase in your equity. And then you have the decreases, negative movements in your assets, or increases in your liabilities, and those are decreases in your equity. Eventually, if you sum all these movements together, what you get is the assets at time 1 minus the liabilities. You calculate all the totals by column. The liabilities at time 1, which are equal to the equity at time 1. Now, let's focus now on the deltas, okay, on these movements. Let's focus on this delta plus in your equity. Your equity increases. Now this time, unlike what we did earlier, we just calculated the total change in equity. Now we're going to measure each single change, okay, in the equity, each single movement in the equity. So it's not the net change in the equity, it's the gross change in the equity, okay, so it's not the net change. And the bookkeeping system is going to track each of those movements. Okay, anytime there is a change in the assets, in the liabilities, in the equity, the bookkeeping system is going to record this change. So some of these increases in equity might be contributions from the owners. But what about those that are not contributions? Well, those that are not contributions are called revenues. At the same time, in case of changes, negative changes in the equity, some of them could be dividends or distributions. But what about those that are not distributions? We call them expenses. So, what are revenues and expenses? And you'll find this also in our slides. I'm going to use it on Monday when we meet again. Revenues are changes in the equity other than contributions, positive changes, increases in the equity other than contributions. And expenses are decreases of your equity other than contribution, other than dividends, other than distributions, right? Now, you do realize that if I summarize all the revenues and all the expenses and I calculate their difference, what do I get? All the changes in the equity other than distributions and contributions. That is, what's that? My performance. If I calculate all the revenues minus all the expenses, it's the same as saying all the positive changes in the equity other than contributions, minus all the decreases in equity other than distributions, what I get is the net income. The same as before. The very same net income, not different, okay, the same net income. However, this time I get much more information, because if I write here revenues minus expenses, and let's say I write here net income, okay, I know what the income is, which is something that I knew already before with the previous system. I also know what revenues, how many revenues I have, and what kind of expenses, because I can label each of those revenues and expenses with a name. So revenues from sales, expenses for labor, expenses for materials. So I have a name that will help me understand what happened, okay, in the year. So net income can be calculated as revenues minus expenses. Okay. So what happens very often sometimes in the exam I ask a student, can you tell me what net income is? And the answer is, well, it's revenues minus expenses. Okay, so what are revenues and what are expenses? And then silence. So you need to be capable of explaining this. Okay, so if I ask you what is a revenue, okay, revenue is this connection is here, an increase in the equity, okay, of the firm other than a contribution. Okay, what is the next step? Realizing that the equity is equal to assets minus liabilities. So when we talk about an increase in equity, it means that there must have been a change in the assets and or in the liabilities. Okay, so if you look at the assets and liabilities, it means that the revenue is either an increase in your assets or a decrease in your liabilities. Right? Other than contributions. Okay, I'm going to repeat this thousands of times, but I had to. And an expense is a decrease in assets or an increase in liabilities other than a distribution of dividends. Okay, so this is the definition. Of course, I'm going to repeat this many times, not just today. So revenues are increases in the assets, so positive changes in your assets, or decreases in liabilities. So if you have an asset that increases, and if you look at this equation here, you have an increase in equity, then you have revenue. If it is not a contribution. On the other hand, when your assets decrease or your liabilities increase, and this affects the equity, but you don't have a dividend, then you have an expense. Now, what is the reason why we use this definition of revenues and expenses? Because I can define what revenues and expenses are without ever using the word money. I never said cash. Never. Right? Why is that? Because it is very important to understand that the revenue expenses are not necessarily changes in your cash, in your money. Cash is one of the assets. So clearly some revenues and some expenses will be cash revenues and cash expenses, but not all. Okay, so that's very important. So you can't tell that revenues are increases in cash. No, those are cash inflows. Okay, revenues are increases in your assets. Among the assets, you have cash. There are many other assets other than cash that could generate revenues. Okay, and the same is true for liabilities, of course. Okay, so an increase in liability will generate an expense without ever mentioning the word cash. Okay, so it's important we separate. We start learning. We need to separate the changes in money, cash inflows and cash outflows, from the performance of the business, revenues and expenses. All right. As you can see, this is rather important to our goals here in this course. So on Monday, I'm going to continue from this, and I'm going to provide several examples of revenues and expenses and how to apply this definition. Okay, but the most important part is linking the basic accounting equation to the concept of revenues and expenses. More of this on Monday. Enjoy your weekend and see you on Monday at 9.